All attendees are in listen-only mode.
Hi, everybody. Thank you very much for joining me today. I appreciate it. You taking your time out on a night to get educated, on a Wednesday night to get educated about multifamily investing. My name is Matthew Owens. I'm a California licensed CPA and a full-time real estate investor, and here to teach you a little bit about multifamily and how we do things with our company, which hopefully will help you to understand multifamilies in more detail and understand how to analyze them so that you can utilize multifamily to be able to retire off of cash flow. It's one of the best strategies to use once you get started in a real estate is to invest in multifamily. It's one of the fastest way to get to your cash flow goals, which for most people is to cover all their monthly expenses with cash flow. So hopefully you get some great education out of this. If you have any questions for me afterwards or during, you can actually ask questions through the webinar. Afterwards, you can email me at invest@ocgproperties.com or you can give us a call at 424-757-4680 and we can have a discussion to see if there's ways we can help each other out. That being said, as most of you know, most of my presentations are strictly education. I don't try to sell anything. I just show you what we do so you have an understanding of the strategies that we implement when we're investing in real estate. So a little bit more about us. As I mentioned, I'm a CPA. I went to UC Santa Barbara. I'll just admit that it was fun there. That's all I'll admit from my fun days at Santa Barbara. I actually got an economics degree with an emphasis in accounting from UC Santa Barbara, and it was between Santa Barbara and Pepperdine, and I saw my first party at Santa Barbara and said, I'm going here. But anyways, so that being said, college education does not make you wealthy. It gets you a job. So I commend you for getting a college education. At the same time, I will commend you much more for getting educated yourself on financial education and learning outside of your normal everyday work. So we've bought I've been investing for 10 years and we bought over 500 houses now and flipped those on the single family side. We buy about 5+ single families per month. I've raised a substantial amount of money from private investors just to help them invest in real estate as well as utilize those funds for my own flips, my own multifamilies. We have a property management company in Memphis with over 200 units, and we primarily comprise of single family and some multifamily investments. We focus a lot on the value add multifamily side, and then we work with different investors with promissory notes, multifamily, single family, and syndications. And I act a lot like a financial advisor for clients to help them with their cash flow goals, their structuring of their portfolios, and understanding what their capabilities are with their current resources, as well as how to develop new resources to compound that growth as fast as possible. So I have a lot of experience in real estate taxation, along with the legal and tax structuring associated with entities and understanding what you should and shouldn't use with regard to real estate. In most instances, it depends on your individual situation. I also do a lot of investment and due diligence analysis for clients. I help with lending and helping raise capital and showing people how to raise capital. I own a property management company, and so I understand the ins and outs of that business to be able to be efficient on your property management and have the right structures and strategies and procedures in place to make a very good management company. We also do a lot of cash flow and market analysis. I help investors structure their self-directed retirement accounts. A lot of investors actually invest with us within their self-directed accounts. And then I also help them set up their own team and understand with a lot of resources and strategies that we bring to the table, including our own team members that we use consistently. So if you need referrals to specific team members, feel free to reach out and we'll be glad to help you out. One primary benefit or one primary thing that we do is we have a nonprofit organization called For Investors by Investors, and we teach real estate and financial education with that nonprofit organization. There's no sales pitch at any of our investment clubs. We have a number of clubs throughout Southern California. You can go to forinvestorsbyinvestors.com to find all of our chapters, or you can go to meetup.com to see all the chapters as well. Our website is ocgproperties.com, and we have examples of investments on there, but each investment is very structured for individual investors versus actually going through and trying to market to the masses. So we really look at each person's situation, and we help investors with 1031 exchanges. We help them with finding that replacement property, as well as we're implementing cost segregation analysis and depreciation structures to be able to help investors depending on their situation. So like I said, we actually buy and invest ourselves. We are operators. So we are constantly buying these. We do all of it. We're not intermediaries. We actually are the primary sole investors, and we have these assets. We own them ourselves. We add value through renovation, through proper property management, looking at the business efficiencies of running a property from start to finish. So, and you'll see that in some of the detail that we put together on our renovation bids, on our different structures and procedures we put in place throughout the presentation. We actually help investors with their cash flow goals, as well as help ourselves with our cash flow goals. We do joint ventures with clients and a number of different things to help investors out, and then give them that proper support to help them to actually achieve those goals. So today we're going to talk a little bit about multifamily fundamentals, some of the pros and cons and the differences of multifamilies. We're going to show you how to compile your numbers in a little bit more detail. We're going to show you how to do the due diligence, some of the things to go through on a multifamily that may be different from a single family home. We're going to show you some of the differences on the lending side with regard to multifamily. Talk about some of the value add strategies that we implement that you can implement on your own deals. And then renovating multifamilies is a very big task comparative to a single family home. We're going to talk about the preventative maintenance figures associated with multifamily and how to make sure that you're allocating enough money for upcoming repairs. And we're going to talk a little bit more about the management and the team members as it relates to a multifamily property and how to go through that in more detail. So let's get right into it. We're going full force. So multifamily fundamentals. So remember, when you're investing in multifamily properties, it's an increase. There's an increase in the actual dollar figure. So that means there's an increase in risk. So if you're just starting out as a brand new investor, you may want to either start with a single family instead of a multifamily, or bring someone else on your team that has a lot more experience so you can get through that learning curve without it costing you an arm and a leg. Single family home learning curves already cost you enough money, let alone a multifamily, which much bigger numbers involved. So there's also tenant-based issues and proper qualification issues. So there's certain areas where that's a low-end multifamily property that have a very low-end tenant base that are not, when I say low-end tenant base, I mean not financially educated. There's a higher default rate. You have more emotional issues, more repairs and maintenance, more headaches that go with a very bad tenant-based property. So you want to look at each property individually and say, what does my tenant base look like? How do I mitigate the risk of having a very bad tenant base? And is it even possible to do that? Is it inherent with the entire area, or is it just this property where you can kick out old tenants and get new tenants in? Because some of those things are really important. And a lot of times when you're buying a new property, you want to understand what those qualifications were in the first place. How many people are behind on their rents? How many people have been behind in the past and have caught up? How many people are under eviction right now, and how many vacancies do you have? So understanding these specific things about the tenant base, I think, can be very key. And a lot of people get into a lot of trouble by getting a property in a bad area with a bad tenant base without increasing the vacancy allowance, the repairs allowance, the bad debts from those tenants, the tenant turnovers. All of those things need to be increased exponentially when you have a tenant-based issue. So that means you need to get a much better deal in order to actually buy a low-end property like that. So remember, all major systems are multiplied. If you're buying a 100-unit building, you have 100 AC units, you have 100 water heaters, you have 100 of every appliance. So remember, when you're doing that, you have to analyze all of the units to understand what the preventative maintenance things are going to be down the line that you have to come up with. So be very, very careful when you're looking at your systems. You pretty much want to have a complete chart of all your major systems and the ages of those different systems in place that can cost you money in the long run. And you can use this for negotiation, saying, I need to replace half the AC units. They're all 30 years old. Or I need to replace half the water heaters. They're all 15 years old. So look at those different things to understand what you're getting into when you first start out on a multifamily. People will go through and say, yes, this is a 9 cap or an 8 cap or 7 cap. But if all those other preventative maintenance items aren't done, you're really buying a lower cap rate on a property because you need to be able to put that renovation money back into the project. So actually increasing your cost and decreasing your cap rate. So a cap rate is basically what your return on investment is if you bought something with all cash. So if you bought it with an all cash purchase for $100,000 and you're making $7,000 a year, then you are making a 7 cap on your money. So understanding your numbers, just like I talked about, that is very, very key when you're understanding these multifamilies, to understand all the detailed numbers. And we're going to break down some of those numbers, some of the differences between single families and multis. There are appraisal differences as well. So when you're dealing with appraisals on multifamilies, they're not necessarily looking at, what the closest comp per square footage is. They're looking at how much that property makes in net income compared to other properties in the area and how much those make in net income. They're also looking at the preventative maintenance on other properties versus yours. They're looking at what things they're selling for on a per unit basis. They're taking all those into consideration when they're looking at your appraisal when you're trying to get financing for multifamilies. There are some major lending differences, which we'll get into as well, that I think are important to fully understand. The lending for single family and multifamily are completely different animals. Okay, so they want to look at completely different things from a lender's perspective. And so you should know those things as you are trying to get financing for multifamilies. And I'll share how that works. There's due diligence differences. There's a lot more things to do on a multifamily than there are in a single family. For example, you may want to get a survey done on a multifamily or get an environmental test on the ground in that area to make sure there's no ground pollution. You want to understand what really big risks can exist to make you want to do those due diligence steps. Those value add strategies like increasing rents, decreasing utilities, there's a lot of different things you can do by to increase the value of that property by adding additional income and decreasing expenses across the board when you're investing in multifamily property. So every time you're analyzing a building, you're looking at how do I add value in every way, shape, or form? How is the old owner being inefficient in their strategies? The construction difference is very, very big difference. And you want to have, especially on very large rehabs, you want to have a very good contractor. You can't get away with, a contractor that isn't top quality when you're dealing with a multifamily. You may be able to cut them off very quickly on a single family, but it's very difficult right when they're in the middle of a project on a multifamily. Finding multifamily deals really has a lot to do with pain points, and just like a single family. But some of the pain points are a little bit different. Are they dealing with headaches on property management? Are they dealing with headaches regarding the tenant-based issues on multifamilies? Are they dealing with financing problems? Because typically on the lending side, there's 7 to 10 year balloons or 5 to 10 year balloons versus a 30-year fixed. There's a lot of different issues when it comes to those pain points when you're trying to find these multis. And it's not like it's very difficult to just get a list and mail to them consistently. You want to find these owners. And a lot of times they're shielded through LLCs and management companies because they want to be hidden. They don't want to be found. So, and then proper property management really depends on the size of the building. You could very well go through and have a 10-unit building where you're not going to have an on-site manager, but with a 100-unit building, you want on-site management and a property management company overseeing them. Typically, in that kind of a situation, the property is responsible for the payroll of the on-site manager, and then you have a much lower property management fee because you have somebody doing a substantial amount of that work already at the property. Okay, let's talk about compiling the numbers. A very fun part for me being a CPA, of course. I will get drowned by Excel statements or Excel schedules all day long and love this aspect of things. But, you know, we're going to obviously start with your purchase price, which really is the number you back into. You start with what the market value is and what it actually produces in cash flow. And then you take out your renovation costs, all of your closing costs and all of your other numbers involved to come up with your final purchase price, and you make your offers based off of that. And you typically want to lower your purchase price lower than what your bottom line figure really is so that you have some negotiation room involved. And you want to go through when you're making your offers on your multifamily properties and explain why you're offering that price in detail to that agent, because you want to give the agent the ammunition to go back to that actual owner and explain why the price was lower than they projected it to be and why they think that it's worth what we think it's worth. Okay? Because if you don't do that, they don't have that ammo, and you're not going to get that deal done. Due diligence costs can be substantially different on a multifamily. So you might want to have an attorney review the contract in more detail depending on the deal, because there's lots of other contracts that can be involved there. You have to, appraisals cost more money. They're a much bigger animal and take a lot more work because they're having to go and pull all the financials of other sold properties and call those agents to get those financials and piece those together, which is not that easy. They're basically doing a lot of the number compilation on multiple comps instead of just taking what it sold for versus square footage and looking at, you know, what was put into the property with regard to single families. Inspections are also very different. You know, on a 100-unit building, you're going to be very far-fetched to find an inspector that's going to go through every single unit. So typically, they go through and they do basically like a sampling of those units to understand what the major problems are with every unit. So we typically do that with an inspector, and then we also send our own people by and look at every single appliance, look at all the issues with the property, so we can understand what things are going to come up in the future. And then we go through that inspection report with the inspector in more detail to get an understanding of what major issues they see and what due diligence and additional due diligence we should be doing down the line. And we also talk with our inspectors to be our eyes and ears when they're going through this sampling. We try to have them go through units that we haven't gone through already, and then also tell us any issues they see with the tenants. We have them ask the tenants if there's any issues that they know about, what problems there are with the complex. You know, there's a lot of great information that those tenants can actually provide to you. Travel costs, very, very important. If you're traveling, like I live in Southern California, if I have to travel to Memphis, you want to build that into your cost analysis there. So research and marketing reports, there's a ton of different reports that you can get from different sources to be able to develop your data. So for example, you need to find out what the market rents are in those areas. You need to understand what cap rate other properties are selling for, and what those things are producing in cash flow, what other intricacies exist in the market as a whole, what's happening with the rents, are they on the decline, are they increasing, what's happening with the multifamilies in the area, what's going on with the crime in the area. There's a ton of market research reports that you're going to put into multifamily that you may not necessarily do all of those on a single family home. Marketing, very, very key. If you don't know how to market for tenants, you're dead in the water before you start. So you have to understand the key strategies to utilize when you are marketing for tenants. on properties because and you can get higher rents when you're a better marketer. You can actually get better quality tenants because you have more leads coming in to choose from. There's a lot of positives for learning the marketing strategies. There's Craigslist. There's obviously a ton of online sites like Zillow and Trulia and syndication sites that will syndicate to all these other websites. There's also pay-by-click marketing. There's flyers. There's signs in the yard. There's referral fee marketing. There's a ton of strategies you can use when you're marketing for tenants. Permits and utility deposits can be much bigger. So if you buy a multifamily building, a lot of times they're going to ask you for a utility deposit. The utility company will, because if they haven't done business with you before, they want to understand that you're going to pay that utility bill. Very, very important. Overhead costs. There's always overhead when you're doing this due diligence. You have to, if you're not going to go through the inspection report, you're going to have somebody else do it. It can be a couple 100-page inspection report that you have to go through. There's a ton of other little things that you might have to pay for that you may not realize off the top of your head. The survey, also important. You want to understand where your property lines are, because one of the strategies to utilize is to put a fence around the property so that it has more security, for example. And if you don't know where your property lines are, you could run into trouble there by fencing an area that isn't your land. Environmental reports. If you're right next to a gas station, you better go get some environmental reports to make sure the ground is not polluted, because you can literally lose everything you own from getting sued from someone that gets sick from something under the ground because you didn't check. And it could be an uninhabitable property in certain cases. I've seen people get just completely destroyed by this. So always have a buffer and your renovation costs in detail. You want to make sure that that's all outlined in detail every step of the way. Holding costs, how much is your interest in the meantime? In a multifamily, you have hopefully some of the units rented to help pay for your interest, even if you're break even. But at the same time, sometimes that interest can be much higher if you're using private investor money. Sometimes it's easier to get private investor financing at a higher rate than it is a traditional bank loan, especially if there's a major construction going on the property. Closing costs can be different on multifamilies as well. They can be much higher. Insurance can be completely different. They will actually go through and inspect your property. They don't always do that on a single family home, but on a multifamily property, they'll come out. We've had them every single time. They do a walkthrough. They tell us, hey, there's a crack in the cement here. We need you to fill it. They come up with a punch list of about 10 little things. It always costs a couple $1,000s to get done on the insurance side, even if you've just fully renovated it. There's other issues like they will not let you have, they want you to have breakers versus the, knob and tube electrical circuits and things like that. There's certain things that cost that are big red flags for them. They want to make sure all the trees are cut back. There's no major issues that cause liability at that property. And property tax reassessments are very, very key. You may buy a property thinking your property taxes are one thing, but you better go through and make sure that you have allocated an increase in property tax when you buy that property based on your purchase price, and understand what the assessment value is and what it might be when you actually go through and buy that property, so you don't get caught with all of a sudden your property tax tripling on you or doubling on you right when you buy that property. So let's look at the chart here. This is how we kind of break down a general analysis. There is some additional items here that are not included in this kind of simplified pro forma. But basically, you're going to start with your gross rents, which are your monthly rents multiplied by 12. You're going to take out a vacancy and a concessions allowance and a bad debts allowance. Concessions is like doing a move-in special, or giving somebody something to move into that property if you're having some vacancy issues. Okay, repairs and maintenance, grounds for the landscaping. On all the multifamilies, you typically have these landscaping costs that you have to cover. Property management fees. Now, like I said, in this situation, you may have a labor cost and a property management fee, and the property management fee is a little bit less. So you also have real estate taxes, utilities, and understanding your utility costs are very, very key. So you want to be backing yourself up with every single one of those numbers on the utilities to break it down in detail, to have a really clear understanding of what the utilities are, not just now, but for the last 12 months. They change in the winter in certain markets, and in the summer you have a lot more heating bills in the winter and a lot more AC bills in the summer. So you want to understand the cycle of those utility bills and get an average for the entire year, and look for ways you can reduce those bills too. So, and then you have your insurance, which can really vary across different providers too. So if you find a good multifamily provider of insurance, then definitely stick with them, and they cover completely different things. One of my largest investors is my insurance agent, and he asked me on certain ones. He wanted domestic violence covered, he wanted dog bite covered, he wanted all the things that insurance companies typically exclude from their policies covered, because he sees the risk of the peril that exists there. And he knows that the insurance companies typically stop covering those because there's claims associated with them. So, we're looking at, on this property in particular, we have a 39% cost ratio comparative to the rents. And so normally, it depends on how high the rents are on a per unit basis, and what you're buying the property for. But typically the cost ratio is anywhere between 30 and 50% on average, with regard to the cost ratio. On a high-end property, you're typically going to be in the 30% range. It also depends if the utilities have been pushed onto the tenants or not. That's a giant percentage of the total overall cost there as far as the utilities go. So if you're looking at that, the utilities is another 6% cost on top of that. And then you have your interest and your principal for your mortgage payment. And you see here where it says combined debt service coverage ratio of 1.84%. That means that your debt or your monthly income of $127,000 is for your net operating income is 184% of your debt service. Normally, for an investor to lend, your debt service coverage ratio needs to be more than 1.35% for them to want to lend on your property. Otherwise, they won't lend. Typically, a 1.84% ratio is pretty good when you're dealing with, lending. So the yield on this one is 9.42%. It's at a 7.5 cap, which puts it at about a 1.954 valuation. And we're looking at about a $1.1 million outstanding debt load there. So I hope this gives you a clear understanding of how this works. As you can see on the repairs and maintenance and all the expenses, we slowly have them increase with inflation, and same thing with the rental income as well. So multifamily due diligence, one of the very keys to your success here is doing all your homework up front. And if it doesn't pan out, don't force it to work. There's a lot of problems that can exist that you don't want to have to deal with when you're dealing with multifamilies versus single family homes. For example, the leasing and the security deposits is very key. A lot of multifamily sellers know that the property won't sell unless it's occupied. And so you want to be very, very careful to review those leases in detail and review the specifics with regard to with regard to the lease dates, the security deposits. Make sure they're enough to cover a move out or an issue with the move out. A lot of times I use this as negotiation to say, your security deposits are half what they should be. Therefore, I need to add another $300, $400 a unit to get those up to where they should be and take that out of the purchase price. To be careful on that side. Or I say, you've just leased 15 properties out of 40 properties in the last month. I need to see the qualifications for those tenants in detail to make sure that they are good tenants. And I want to look at the background checks of them. I want to understand how they've qualified. Are they using a typical qualification, making them make 3 times the rent amount to qualify? Are they moving them in with previous judgments or evictions on their records, and I want to understand and see all of that information as best I can. Sometimes it's hard to get that information, and you have to take a risk, but allocate additional reserves as a percentage, saying that this percentage of tenants I think are going to be good, and this percentage might be, an issue. So inspection reports, like I mentioned, we go through and I make sure that my inspector outlines the age as best as possible of all the major systems in their sampling, as well as the age of the roof, the age of all the AC units, what they think needs to be repaired and doesn't need to be repaired, and then I have them go through that with my contractor and me in detail to make sure that I understand everything that they see and what issues may come up in the future. Service agreements. You may have a landscaping agreement, or you may have a utility agreement, or a security agreement. There's other types of agreements that come in place depending on what those expenses are when you're investing in multifamilies versus single-family homes. Insurance policies, like I mentioned, can be completely different. We talked about that. We want to get the bank statements and the deposits to understand what deposits have been happening on an annual basis and a monthly basis for those units, so that you can get a gauge for how much rents are actually coming in and what the net is every time. A lot of people put more money into the property, and so they may have backup for capitalized costs versus expenses, and so you want to understand what they capitalized recently, what major renovation they've done in the past. Financial statements, understand what the numbers really look like. Look at their tax returns if they have them available to do so. Sometimes they're mixed in with other units or inside of an LLC or something like that, so maybe a little bit more difficult to get that information. And some people are just, quite frankly, not organized. And so if they're not organized, it becomes a little bit more difficult, but you can request those tax returns and see about trying to get those. Utility bills, also very, very important. Like I mentioned, you want to outline every single month what the utility bills are, and also call the utility companies to make sure that you've been told about all the company accounts. What are the property accounts for the main accounts, as well as all the individual unit accounts, so that you know you're getting a complete picture and not being told that you're making sure that the seller is not telling you utilities, or not telling you about utilities that actually exist. Appraisals, we talked about understanding the multifamilies with regard to appraisals, and how they think about these properties, and how they think about analyzing the rental income associated with them. Environmental reports we talked about. Surveys, very, very important. Understanding the payroll. Is the previous owner paying payroll taxes? Are they doing it right? Or are they paying them as a subcontractor? Is that right for the area? What if they're being underpaid? So understanding what market is for payroll is important. Getting a complete inventory of furniture, fixtures, and equipment, and all the different assets that go with the property, so you can put it in the purchase contract, and that you know the age of all those different systems is imperative. Putting together a useful life spreadsheet so you know when those things may need to be replaced in the future. Looking at the property tax reassessments, and looking at litigations history. What if one of the tenants is suing the current owner? So you want to understand if there's any outstanding lawsuits that are going on with this property specifically that are going to carry over to you as the new owner. So let's talk a little bit about the lending side of multifamily, a completely different animal. So let's talk about what these banks are actually concerned with, because we all understand how it works with a traditional loan, where you're basically putting 20% down or 25% down and getting a bank loan, and they're making sure that you personally qualify for that financing, and that you personally can pay that monthly payment back based on your debt to income ratio, your credit, your personal financials, and that's much more focused on you. On a multifamily, they're looking a lot more at the property cash flow. How much is that property going to support that monthly payment? They're looking at it from a business perspective. How are you going to be able to go through and how's this property going to be able to go through and pay that payment? Not necessarily you. So they do want to look at your strength and understand that if something negative happens to the property, that you have the money to step in and solve that problem and cover it if there's downside that happens with that asset as a whole. And they want to understand what your experience is. So a lot of times they will not lend to you if you have no experience running multifamilies. And if they are going to lend to you, they want to understand who's managing that property and what experience they have as well. So the property management is much more key on a multifamily than when dealing with a single family home as well. They want to know who is going to be in charge of that, what their experience is and their reputation is. So you're building the story for them in that situation. Typical terms are a lot different than single families. You're dealing with, on average, a 4.5% to 6% rate. I've seen them in the fours. They might be a little bit higher now that we've seen some, increase in rates recently. We don't see, sometimes we see 20 to 30 year AMs. A lot of times you don't get 30-year AMs. They want to do a 20 to 25-year AM. Usually the longer term amortizations are on much higher end properties that are, above 2 million to 5 million in cost. You can get better financing rates for those types of assets. If you're dealing with a smaller building, you're typically going to be looking at 20 to 25-year AMs. And a lot of times, lenders don't like to touch properties that are below $1 million. It's much harder to get financing on below $1 million properties than it is on above $1 million properties. So you typically on lower than $1 million, you typically have to go to a local lender to get that put in place. And a lot of times they'll have 5 to 10 year balloons instead of 30-year loans on these. So they'll do a 20 to 30 year amortization, but a 5 to 10 year balloon. I'm seeing right now, because the banks don't want to take interest rate risk, they might do a 5 to 7 year type balloon. So, and then there's usually a point or 2 points involved in that transaction. I try to cut them down. It depends on the size of the property though. So larger multifamilies versus smaller, like I mentioned, you get better financing on the larger multifamilies. You get worse financing on the lower multifamilies. It's just not worth their time as much. So, and when you're dealing with construction loans on these multifamilies, it's important to understand that they have basically construction draws. They're not just going to go give you the renovation bid. We just did a very large renovation, over $600,000 renovation, and we had to have specific draws where we had to pay for the money up front and then submit to them everything we did, showing them the receipts and the backup of everything involved to then get, and then they go and send an inspector out to go look at the work to make sure it was done. Then they give the draw to you. So you have to make sure you allocate enough upfront capital to pay for that renovation. Don't just assume the bank is going to give you that money right up front. You want to make sure that is actually paid for. Look at the different costs involved in these loans. A lot of times you're looking at, they have specific insurance requirements and involved that they want you to make sure that you have proper insurance for, and so that may increase the cost. The points are a cost. They may have other, closing costs that are involved there that may not be customary for single-family homes. And then you're looking at local lenders versus national lenders. Local lenders know the market when they may be willing to lend on something that a national lender is not. Okay, the fun part, the part we make a ton of money on, okay, is value add strategies, which another word is forced appreciation. Okay, and so this is the strategy that I recommend, that I do most of the time when I'm investing. So I first thing you look at is the rental increase associated with these types of properties. And that's the most important thing to do, is look at the rents. Is it under market rent, or is it at market rent already? And if it's not at market rent, what do you have to do as far as renovation goes to get that rent up? Is there specific things you can do to the property to get that rent in the right direction so that you can increase the value? Because if you do the math, if you were able to get on a 100-unit property, you're able to get $100 more per month, per unit. That's $10,000 per month. At 12 months, that's $120,000 a year. If you're doing an 8% management fee, that nets about $110,000 a year. At an 8 cap, that's an increase in value of over $1.3 million if you're able to increase 100 units by $100 a month per unit. So think about that. That's really amazing forced appreciation. But to get a $100 rent increase, you typically need to put a substantial amount of renovation in. So in order to do that, you may have to go spend $500,000 in order to get a 1.35 million plus renovation or value increase, which actually still makes sense because you're still netting a giant chunk of cash on your increase in equity there. Utilities. Also very, very key when you're looking at efficiencies. So can you put in energy efficient strategies here and energy efficient appliances? Can you put drip systems on your water faucets so that way they're low flow type systems? Can you push utilities onto the tenants and subdivide those things? So these things are all very, very key. So looking at those energy efficiencies in this tenant billing is very key. Can you dispute property taxes and reduce the property tax appraisal? Is it higher than it should be based on what you're buying that property for and how much work it needs in the property? Is there ways of reducing the insurance costs and taking some of that cost on yourself or some of that liability on because you have an LLC in place or something along those lines to protect you personally? What about the landscaping? Can you actually make the landscaping so you don't have a landscaping cost or is significantly reduced? So, if you have a lot of grass, for example, you want to be able to try to get rid of it so you don't have to mow it, you don't have to water it, you don't have to keep track of all those things. But you also, if you go and do, low maintenance type landscaping, you also still have some maintenance. What if grass is growing up in between, the pebble stone or whatever you're putting in place? But trying to reduce those costs can be substantial when you're investing and trying to increase value here. Doing all the preventative maintenance up front can actually really reduce this. So typically when you're investing in these value add strategies, it may take a year or two to actually increase the value to the point where you need it to be increased. And so when you're actually doing these repairs, you want to say, can I get it all done now and solve these problems so that my repairs are less money for when I go sell that property afterwards, so that my last year before sale doesn't have very many repairs that need to be done. Additional income sources. Can you put a solar panels on the roof and bill the tenants for those utilities, or help the utilities and then therefore help decrease the utilities for those tenants and therefore then increase rents for that value? Can you go get signs on top of your building that people will pay you to lease that space? Can you put a cell phone tower up there? Are there vending machines you can put in place? Laundry facilities? All these little income methods that you may be able to add that would substantially increase the value of the property without a lot of additional cost. Subdivision of units. Sometimes, or even a combination of units. Sometimes if you're subdividing, you can go through and separate, if you have a couple of, call it 10-unit buildings that are right next to each other on the same land, you may be able to subdivide those into 2 separate 10-unit buildings and sell them separately. Or if you have, a 20-unit building and a 100-unit building, you may be able to go through and combine them if they're right next to each other for financing purposes and get a better loan and get better efficiencies by having combined property management, things like that in place. Repositioning or repurposing that asset. What happens if you go find an old single-family home and you convert it, that's a giant single-family home, and you convert it into units? There may be a way to be repurposing that building or that asset for that purpose as well, or repurposing a commercial building as a residential. Vacancy reduction, having really streamlined marketing and really focusing on quality tenants, as well as you want to go through and have a really good tenant retention program. So some of the things you can do is give them birthday cards and holiday cards, give them a turkey for Thanksgiving, or or go through and give them a Kroger gift card, or things like, or a grocery store gift card, to be able to increase the value that you're bringing to that tenant. Have great communication where you actually go through and fix every little issue right away with that property, is key for proper tenant retention. Having those qualifications where they make 3 times the rent can be very important too. And having a sense of community. Maybe once a quarter you do a barbecue, or you do a newsletter to the tenants on financial education or things to help them save money, and that type of strategy to communicate with them consistently and have a sense of community within the complex can be very, very key for tenant retention. So, and that communication is very, very key. You got to get back to people immediately with repairs. Even if you can't get somebody out there immediately, you want to have that communication with them for scheduling. And clean house of all the bad tenants right away. So if you have gangsters at your property, you have people that are causing headaches for the other tenants, get them out right away, because there's going to be other good tenants that are moving out because of those bad ones. So, and administrative expenses, there's ways of streamlining your property management so that you can reduce expenses. For example, we use Buildium Property Management, which allows us to, software, which allows us to go through and streamline all the marketing online with multiple sites. We're looking into using this software called Rently that actually stops leasing agents from having to use your property. So these are all the different strategies that we utilize when we're investing and trying to find new technology that can decrease costs and increase efficiencies. So here's how we break down the rents on a unit. So this is like a 30-unit property that we utilize, and we're constantly going through and adding these different strategies to the mix. And you can see here, you know, the annual rent increase after management fees is about $24,000 a year, from the current market versus the current rents versus the market. So that's a 30% ROI on a $4,500 rehab per unit. So, and I can basically do it over time as the tenants move out, and do, you know, 3.5 a year as they move out of this property. So this is how we break things down. This is how we break down the renovation on a multifamily, where we come up with a current estimate and we add all the, we come up with an initial estimate, we add all the current estimate associated with it. We break it down item by item, breaking this thing down in detail so that people have a very clear understanding of what multifamilies look like. So you can see here we have the initial estimate and the current, what it actually cost us, so on this project. So then we also have, this is how we break down the interior of units. This is actually a single family home, but at the same time, this is how we break down the interior of these units when we're dealing with multifamilies as well, to come up with a line item by line item cost analysis so we can get a cookie cutter approach to every single unit in that property. And you would do this for a 1-bedroom, a 2-bedroom, a 3-bedroom, whatever the unit size is for your unit. So renovation contracts, also very, very important. So you want to make sure they have a certificate of insurance in your contract with workers' comp, general liability, completed operations, auto policies. You want to have material supplier identification. So who are all the vendors they are using for their HVAC, their roofs? You want to make sure that you get lien waivers for each one of those. Do they have their contractor's license, and is it current? Make sure you get W-9 forms for them so you can actually write this off for tax purposes and understand what entity they are doing business out of, and look up that entity, do background checks and all that stuff on each contractor. Get lien waivers from them and all of their subs. A lot of times we will pay their subs directly and get those lien waivers at the same time that we pay their subs. So, and get a guarantee and warranty for 1 year for defects. Sometimes it's harder to get them back in there, but you can do a holdback, which can be a negative situation for them, but you can do a holdback if you think there's going to be problems. We put time provisions in there with penalties and bonuses so that if they tell me a certain time, I usually give them a couple weeks or a month leeway. After that, we start charging penalties. But if they get it done faster, they get bonuses. Change orders. They don't make any markups on change orders in any of our contracts. So if there's a major change to a property, unless we made that change ourselves, they don't make any markup on that as far as their commission goes on doing this, their management fees. Permits. We typically take care of the permits in-house versus letting the contractor do that because we want to have control over the job. We don't want the contractor pulling these permits and then having a problem later on where we need to fire that contractor and then having control and having us have to go re-pull permits all over again. Make sure you can actually, on a big jobs, you can have them get bonds where they can put up. So most professional contractors will have bonds that they can put in place. And have a draw schedule. When do they expect to get payments? So we actually put the bid, this is just half of the bid, but we put the bid in an attachment to the construction contract involved here. So we also get a unit map put in place too, where we can actually go through and understand what the entire outline of the property looks like on each property. So we also know where our survey is too. We get a complete layout of every unit too, so you can have a full understanding of what paint is going to cost, what carpet is going to cost, all the different strategies involved to decrease or to come up with your numbers as accurately as possible so you don't have overages. That's from a software called Punch, by the way, the layout software. It's a great software to use. And then it's very important to get your documentation. No lender is going to buy from you, and the appraiser needs to see all of what you've done to the property, or no lender is going to lend to you. No buyer is going to buy to you unless you can actually document everything you've done to this property in detail. So we get the before and after pictures and video, all the detailed renovation, the useful life information, the layouts, the inspections, the financials, the leases and the rent rolls and the security deposits, the utility backup and other insurance contracts, all compiled for you when you're trying to sell this property. So this is the before pictures of this 19 unit that we actually did, and this is the after pictures. So it looks absolutely beautiful now. We did a full renovation inside and out to this building. I mean, the whole thing was boarded up and this thing was basically rebuilt. So everything was completely torn out of this property. Here is an example of a useful life calculation that I think is really, really important when you are buying multifamily. So if you know your roof has 20 years left on it and it's going to cost you $30,000 for example, which obviously on a multifamily can be much more than that, then you want to say, okay, if it takes 20 years to do that, it might cost me $1,500 a year to put aside, which is about $125 a month. If you're going through and doing AC units, furnaces, water heaters, major plumbing, all these different aspects, you outline it to see how much it's going to cost you a year, so you can outline it on a monthly basis and look at it on a per unit basis too, how much that's going to cost you. So you can allocate reserves for capital expenditures that are going to happen in the future. So team members on multifamilies, really important to have those local bankers and those national lenders that can help you out. Having the private lenders on deck for major renovation jobs and those value add deals. Affiliates and other management companies that can give you feedback on the rents, that can actually go through and help you find deals. Having that proper insurance agent that understands where the risks are associated with multifamilies, that specializes in that commercial and understands what the bank requirements are too. Understand the laws in that state from the tax law perspective as well as the legal perspective. So having an attorney review the LLC agreements and loan documents. Most commercial lenders will lend to an LLC versus residential lenders will not typically. Commercial realtors set up for the sale of that property and getting their feedback. They'll give you tons of great information on what they think it'll sell for. Inspectors, looking at the samplings we talked about, understand those reports. Commercial appraisers, have them on deck. contractors that can handle these large jobs, and property managers for on-site management, understanding those procedures, and ask them what their tenant retention procedures are, or what things they can put in place, and that they understand the tenant landlord laws in the market. So that being said, if you're trying to find the right investment for you, you have to understand your own risk tolerance level and how that works. You have to know how much time you have. Are you trying to be an active investor or a passive investor? Are you going to rely on a property manager, or are you going to try to do this yourself? What return are you comfortable with? Are you aggressive and going to shoot for those active level returns? Or are you more passive and trying to accumulate returns over time and would rather have something that's done for you and ready to go, but with a little bit less of a return? Do you understand how you're protected on each investment? Do you have the right legal and tax structures in place and the right insurance in place? Do you have the capabilities in the first place of using that bank leverage? How are you going to look from a lender's perspective, and can you position yourself to look in the right light? How much cash resources have you allocated for investment purposes? Do you have versus your own budget as well? Like, do you have those reserves aside for yourself and then an investment budget too? Do you have time or other relationships that you can add value during when you're investing? What are your current cash flow goals and your monthly expenses? Very, very key. And develop a plan, put together a plan. This is how much cash flow you need to retire, and put that in place. Here's some ways to work with us that I'm going to speed through. So we have single family homes where we do seller financing, bank financing, and we do joint ventures at our cost, as well as cash investments and wholesale deals. We also put together property packages for investors that need 1031 exchanges or have different needs that are involved. We work with investors on multifamilies where we will joint venture with them on multifamilies. We will also go help them find multifamilies that fit for them with our real estate brokerage. We'll manage the renovation and manage the property and the project for them. We also do promissory notes, short-term and long-term. We do syndicated investments, typically with self-storage and different asset classes. And we have an awesome affiliate program where investors can make a substantial amount of money just bringing us resources and helping plug into our system. So why work with us is we have property acquisition choices. We have renovation expertise. We have the tenancy expertise and the property management. We understand the neighborhood and the market. We can help investors cash flow from day one. We know how to mitigate the risk for our clients and know how to do the due diligence, have proper financing options set up for our clients with the right relationships. We understand the state tax laws and the tenant laws and liability issues in certain states. We help with the property repairs and have team members there to do that. We set up inflation hedges for our clients through investing in cash flow and where rents appreciate over time. We can set up the depreciation benefits and even compound those depreciation benefits into the first 5 years of ownership. And then we can help our investors leverage as well. So that being said, our typical process is we take an investor through a current 60-minute consultation. We go through and understand their situation specifically. Then we go through and review the investment options and what options might work, for them. And if it's not with us, that's fine too. We can help you understand what you want to do and help you understand what risks exist and how to position yourself, and help you pick out an investment after that and ask all the questions, go through all the quality control and the due diligence documents that we put in place. And then we close escrow. It's as simple as that. And then you rinse and repeat over and over again until you actually are financially free. That's the whole point of this, is to continue to do that. And we can even teach you how to bring in other resources like other capital, other investors to help to actually make more money with us. So that being said, and I'm almost done, guys. I know we're almost at our limit of time, but what are your next steps for financial success? You want to develop that strategic financial plan. Assess your current financial situation, your assets, liabilities, income, and expenses, so that you know where your starting point is. You can't find out where you're going to go unless you know where your starting point is and what you need to cover on a monthly basis. Find ways of reducing your expenses, which is inherently reducing your taxes as your biggest expense. Set up the right legal structures and increase your income. So it starts with financial education and understanding what to do with your own financial situation. So set the right financial and life goals for yourself. So you have to have that defined goal outlined completely. Look at your 10-year picture, your 5-year picture, your 3-year, your 2-year, your 1 year, and break it down in detail into so you have a strategic plan to get there, and don't ever stop thinking about it. It's the most important thing you can do, is to constantly focus and move forward and take action. So I really, really think it's important to continue that education on the financial education side. Every time I read a book or listen to an audio tape, it spews me into action, to taking action and moving forward into something I know I need to solve. So it really does train your mind every single day, and you want to work with people who think like you do. So poor people, middle class, and rich people think and talk about completely different things. So if you're actually going through and talking about the latest sports game, there's a place for that, don't get me wrong. But at the same time, you hear a lot less of the successful person talking about sports versus the new strategy they implemented to actually help them invest and get to their goals. And it comes up with a ton of new things. And the more you achieve in your life, the more fulfilled you'll be and the happier you'll become. I'm not just talking about the financial side. I'm talking about the more you achieve on a personal level, the more you actually get to your goals to create the life that you want to live. So if your goal is, the whole goal is to cover your monthly expenses with cash flow until you're financially free. But the real end game is what that does for you to be able to create the life that you want to be living and do the things you want to be doing, which is spending time with family, teaching your kids, having fun, and going and doing things and helping other people. That's probably the biggest thing you can do, is help other people achieve the same goals and the same level of success that you've had. So if you like this presentation, we have some new investment club meetings coming up. We have a For Investors by Investors Long Beach coming up next week, and we're talking about investing in out-of-state real estate. We have a brunch and learn on April 8th from 9 a.m. to 11:30 on investing in promissory notes. We'll have a panel coming in there. We have Bill Tan coming in and Gerald Lemoyne, which are quite frankly just geniuses when it comes to note investing. And then we have our For Investors by Investors in the South Bay that's actually in El Segundo on April 12th on creating long-term wealth through promissory notes. And we're having different professionals come in there to talk about promissory note investing and answer questions for different people. So your next steps for success, if you want to email us, you can schedule an appointment and we'll sit down and talk about your financial situation and how we might be able to help. Or, if we can't help, I'll kind of point you in the right direction of what you can be doing now to get you started. I'm really an expert at finding the resources people don't even realize that they have. So if you want to sit down and have a conversation, I'm willing to do that with everybody on the line. You can fill out a client intake sheet if you're interested in working with us, compile what resources you have for investment purposes, and review your specific cash flow goals and monthly expenses to cover. And then review your investment options, determine what types of investments are right for your situation, and start developing a cash flow stream to really get you there. So, and you can also sign up for our Phoebe clubs if you're interested to continue that education too. So we also have this awesome networking platform, ocgproperties.com/en for English /networking, where if you need resources, where you need an attorney, you need a CPA, you need different team members, you can put your information in there and we'll help you provide those team members to you. If you are a provider yourself and have resources, you can put your information in there and tell us what resources you have, and we'll try to match you with the people that need those resources. So here is my contact information. I really appreciate you guys coming today. You can get more involved basically by contacting us and emailing me at mpo@ocgproperties.com or invest@ocgproperties.com, and we'll help you out any way we possibly can with regard to the investment. So that being said, thank you guys very much for investing for talking with me here. I look forward to working with you guys in the future, and I hope you guys have a great rest of the night and enjoy the night. Go get some dinner and relax. Thanks a lot. I'll talk to you guys soon. Bye-bye.